Hi everybody, welcome back to Advanced Mortgage Solutions podcast. Here with your host Joel Sadler and our expert and founder and owner of Advanced Mortgage Solutions, Scott Miller. Scott has put this podcast together to really help educate people in the property market, whether you're a first home buyer or a seasoned investor, really just helping people in their property journey. And it's a bit of a labour of love, it's a way of giving back and just helping the local community as well. So Scott's been a property investor for over 20 years and his professional backgrounds span logistics, management and finance. And look, he's been serving Christchurch and Canterbury for nearly 20 years, haven't you, Scott?
In the 20th year, Joel. So April next year, I think, is Advanced Mortgage Solutions' 20th birthday. Yeah.
Gosh, yeah, congratulations.
Thanks very
it's
much.
A long time. And yeah, one thing I would say, I don't see too many businesses around with like 400 plus 5-star reviews. So you're in safe hands, the market's spoken. Also, the feedback on Reddit's amazing as well. So with Scott, you're going to get really down to earth and honest and really valuable relationship and experience, which I think sometimes can be quite rare to find that. So I think it's definitely worth reaching out if you get the chance. Right, so today's episode, we're going to cover off another really hot topic, and that is how do I pay my home loan off faster? And we were saying earlier, Scott, that, you've seen everyone from, one end of the scale who kind of just ticks away over 30 years and pays their home loan down, versus other people who are kind of like, how do I pay this off in 5 years, Scott? Really adamant of like taking advantage of every little way they can do that. So with that knowledge, Scott, what would you suggest to someone who's more inclined to want to pay down as quick as they can?
Look, it's a great question, and different banks have different products. I mean, ultimately, I'd like to start off by saying that it's a good idea to have a balance between paying your mortgage off as aggressively as you can, but also have a life balance there as well. You don't want to be too aggressive and then miss out on some of the niceties that you can have with a bit more cash flow. Look, different banks have different facilities and different banks have different levels of technology that allow you to pay your mortgage off very, very quickly. Some banks, for example, will let you to pay up to 20% of the minimum repayment even within a fixed term with no penalties for doing so, where others aren't quite that free and you sort of got to ring the bank and organise them to increase the payment and reduce your term. And it's not very, let's say, fluent at that end of the market. But in regards to the differences, I suppose, I'm not one for sitting there and wanting to pay my mortgage back over a 30-year term. I'd much rather get it paid a lot quicker. And that's where lump sum payments or increasing minimum repayments or using line of credits or offset accounts to your advantage is certainly something that will dramatically reduce the years that you repay your mortgage off. And largely, if it's set up correctly, you wouldn't even notice that it's there. It's just working in the background every day in, day out, working for you and taking those years away from the repayments towards the bank and your mortgage.
Right. And yeah, so let's zoom on to those areas you spoke about. In terms of increasing weekly payment, say someone was paying $450 a week, would they reach out to you to say, look, hey Scott, I've had a salary increase now, I've been bumped up, we've talked about it, we can afford another $100 a week or $50 a week towards our mortgage. How do they practically go about doing that?
Again, depending on the technology from the lender, a lot of the time you can now do that on your app. I'd like to have that conversation first just to explain why increasing your repayment does pay your mortgage off quicker, and to sort of explain that from a helicopter point of view. A lot of people don't realize that when they meet their minimum repayment, they have met their interest repayment obligation. So they've met the obligation that they have to pay the amount of interest back to the bank that the bank have got you under contract for that particular term, be it 1 year or 2 year or whatever you've signed up for. And then so any increase in that minimum repayment now, because you've met your interest obligation by making the minimum, comes completely off your principal amount. So in the example that you gave, if they're paying $400 a week or a fortnight off and they increase it by say 20%, which would mean a $90 increase, then that $90 would come off the principal every time they made it, and that's what pays them the loan off super quickly.
Interesting. Yes, I've heard of that before. That's really powerful. Because which then cycles back round and reduce the interest you're paying, and it just has that ripple effect right the way
100%.
through.
Yeah. Look,
Yeah,
that kind
yeah,
of repayment is slightly more efficient than, say, a lump repayment because you're making that repayment every single week, fortnightly, month, depending on what you've opted in for your repayment frequency. Where a lump sum payment, although very effective, don't get me wrong, and I'm not saying it's not a good idea, it's not quite as effective because you sort of got to wait to the end of a loan term to place that one big lump sum against the loan. So, for example, you're
yeah,
coming to the end of your 1 year term and you've saved up $10,000 that you're not going to miss. Woohoo, wouldn't that be nice? And so then the loan comes up for renewal and we place the $10,000 against that mortgage before we refix it in for whatever new term we're looking to do, depending on the rate cycle at the time. Still a good idea, but not quite as effective or efficient as those weekly, fortnightly, or monthly increased minimum repayments.
I like that sort of investment mindset as well. And I suppose for those that don't know, Scott's actually a certified financial advisor. Is that right? Financial advisor and planner.
Yeah,
That's the technical term.
it's not so much a planner. I can't tell
Mm,
people how to budget, for example. That's a different type
mm,
of license. But certainly, yeah, I'm a fully licensed financial advisor that specializes in the mortgage space. And that can be for
yeah,
first home buyers, subsequent buyers, rental purchasers. I'm free to talk about interest rates and what I think they're going to do, where we are in property cycles, all those sorts of things. The license that I hold to do my job allows me complete free rein in that area. It's only the
yeah.
budgetary advice or multi-level investment portfolios. I'm not really covered to cover that information either. But play in your lane, and you certainly become an expert in that area.
100%.
Yeah.
And I like that. I like that mindset of, investing a little bit extra each week, into the
The principle,
principal,
the principle
not
of
the
the
interest, the
yeah,
principal,
yeah.
not the capital, but yeah, it's pretty
And
powerful
you don't
over
have to do
time. Yeah,
much. You don't have to
yeah,
make much of an increase on your minimum repayment to make a massive difference in the years that you'll be repaying your mortgage. I can show you
yeah,
those figures live when I'm with clients. We
yeah,
usually go through that conversation when we're having a pricing meeting, initially setting up the mortgage. I go, hey, look at this, watch, if we increase your minimum repayment by this amount, look how many years that takes off your mortgage. And, a
yeah.
lot of the times people's eyes fall out of their head and just didn't realize that such
Yeah.
a small increase can take
Well,
years and years off your mortgage.
yeah, yeah,
Yeah.
amazing. You've got me wanting to look at that now, Scott.
Yeah.
Oh, awesome. Hey, look, the other thing, obviously, I've heard again bandied around the term, and I'm sure a lot of people have as well. Is hey, get your credit cards and put all your spending onto your credit card, ride the interest-free period, and keep that cash in your more revolving or mortgage account. Tell us a little bit about that. I imagine it's probably technical, or how, do you want to give us just an overview of that as
Yeah.
someone who hasn't heard about that before?
Look, it's certainly something that we did very often 10 years ago. It's sort
Right.
of been superseded now with the invention of offset accounts. There's not every bank has an offset capacity, so it won't work at every bank. But what you do is set up a line of credit facility. Some call it a revolving credit facility. It's exactly the same thing, just called differently by
What does
different
that mean,
banks.
Scott? What does
Yeah, I
lending
mean,
facility revolving credit account mean for those that are new to the?
it's part of your mortgage, but you can
Yep.
aggressively pay it off. So if you set up
Right.
part of your mortgage that had a limit on a line of credit facility for $20,000, for example, then you can
Yep.
lump any amount of money against that and bring it down to zero as quickly as you can. The beauty with
Right.
a line of credit facility is they allow you to redraw that money back up to the 20,000 if you ever needed it for a rainy day event, for example. So it
Right.
certainly assists in making your mortgage cheaper by doing that because your 20K isn't at the 20K limit that it started. If you put, money in, money in, money in aggressively and got it down to 10,000, then you'd only pay repayments on the 10,000 even though you've got a $20,000 limit. Um, by adding a credit card to that, what people were doing is they were buying their groceries and paying their petrol and just general life expenses and not have to draw that out of the line of credit immediately. They could just wait until the end of the month and then pay the credit card off in full. And it meant while you had that money in your in your line of credit account, you weren't being paid interest on it. Like I said, to a degree, it's been superseded now with offsets. So an offset, although it's part of your mortgage still, you have your money still in your account, not in the account of a line of credit facility, for example. Getting a little bit technical now, and it's best I show these in front of people with drawings and things. It makes it a little easier. But look, both of those facilities are definitely out there and definitely good to use, 100%.
Interesting. Yeah, brilliant. And then the last topic for today, Scott, or question for today, is around, we talked a wee bit about lump sum payments, but say, for example, I had an auntie pass away and she left me, I don't know, $50,000 in her will. The first thought that would go through my mind is, hey, whack that against the mortgage, reduce some cash flow, or maybe take a portion of that and put it against my mortgage, and with the rest of it buy something else, But any sort of lump sum things like that, or say, someone makes 100 grand out of the crypto bull run and they want to cash that out and put it into property. What would be your advice around, say, taking that 50 grand from auntie and putting it into the mortgage?
Look, and with that inheritance piece, it is most of the time people want to use the money for a good purpose because it's come from a loved one that's passed and things like that. They, don't want to just, frivolously spend it away. So quite often we do have that situation come where they've come into money and they want to do something important that would change their lives, and paying down their mortgage is an obvious one. Look, we can put it aside if a loan hasn't rolled over or is not about to roll over recently. We put it aside into a good interest-bearing account, so it's earning a bit of interest, waiting for one of their loans or a loan to roll over. And simply rolling over means it's coming to the end of its fixed period. Like we mentioned earlier, that might have been 12 months. Next month, that 12-month period is up. We instruct the bank to say, hey, we've come into 50K through inheritance. We'd like to use 40K of that from our savings account and place it against the mortgage, lowering the total by $40,000 before we refix it in for a new term. And the bank will say, sure, no problem. And on the rollover date, they'll follow the instruction that we've given them. And indeed, the size of that particular mortgage would go down by 40K. It's common when you do come into money like that. At the moment, I suppose on the crypto side of things, people might suggest that they're earning a little bit more in the crypto returns than they would save on the interest rate that they're receiving, at the moment, with rates being quite low. It's not hard for some investments to outstrip the level of interest that you'd get. So then it's a sort of a decision on, do I want a mortgage that's lower and be happy about that, or do I really want to continue to invest my money in something that might be receiving higher returns? So it comes down to more of a personal choice around that.
Yeah, that makes sense. Awesome. All right, Scott, thanks for today. It's been amazing. If somebody's listening and wants to reach out to you to have these type of in-depth conversations and even extrapolate more gold out of you for their situation, how do they get in touch?
Yeah, look, the website's probably the best place to go. There's all sorts of tools on there that you can help. There's mortgage calculators, there's first home buyer guides, contact forms, obviously, to contact us so we can come back and contact you. There's our phone numbers, personal phone numbers, and email addresses on the website as well. So it's that one-stop shop right there.
Thanks again, Scott, and we'll see you on the next episode.
Thanks, Joel. Have a good day.